Joining me now with more is Larry Werther. He's a chief U.S. economist at Daiwa Capital Markets. Larry, it's great to have you.
Kristen, I'm delighted to be here. Thank you for having me.
There's so much to talk about today, including data that was out pre-market. But I want to hear from you as an economist. What is most on your radar?
Absolutely. I think certainly tariffs are top of mind, as you alluded to. The key thing for me right now is that they generate a good deal of uncertainty. Recall a few weeks ago, the discussion was what they would do to inflation and how that would complicate the picture for the Fed. And I think more recently, the discussion has turned to knock-on effects on growth, have recession risks increased, and the like. So certainly there's a lot to unpack, and the president's pivots almost by the day certainly make it difficult for forecasters.
So with the losses that we see pre-market, S&P probably about down 6% from its recent high. What would you advise viewers watching the show if they are looking at their portfolios and perhaps getting nervous?
Sure. I mean, from my point of view, I like to say proceed with caution. The S&P is up approximately 50% previously in the past 2 years. And I would say that the growth outlook for the U.S. is still pretty good. Corporate profits are toppy, but I think there's a lot of dynamism under the surface. And I would add, from my seat, I think the U.S. economy is still on track to grow around 2% this year. I think we're likely to get a little bit more easing from the Fed. So I think, generally speaking, conditions are supportive for ongoing growth and at least a decent performance in the aggregate.
So let's do talk about some of the recent data. We got jobless claims this morning. Those were actually lower than expected, which was good, but we also got some data in terms of from the Challenger and Gray report, layoff announcements soaring to their highest level since 2020 as the DOGE federal government cuts take effect. By that particular report, they had seen more than 60,000 cuts to the federal government workers. We will have the jobs report on Friday. How does that factor in?
Sure. Certainly DOGE is generating some consternation. You're likely to see some job cuts coming from the federal government. In the aggregate, though, I'm of the view that the labor market is strong. Job growth, I'd say the run rate's probably around 150,000 per month. It's right around where we were prior to the pandemic, a period in the labor market that Chair Powell identified as beneficial for the broad host of economic actors. Unemployment is low at 4%, and to date, layoffs have been relatively low. In fact, they're tracking below where they were prior to the pandemic. So from my seat, I think the labor market's in a pretty good spot right now, despite what's going on in the federal government.
We saw the ECB recently cut rates. It is obviously worrying about growth, but also now needing to ramp up defense spending, of course, as we see what unfolds in that part of the world. How does this all impact rates here in America?
Sure. I think the ECB has started cutting earlier than the U.S. You saw a jump in rates, with the expectation of a new fiscal program coming from the Germans. I think there's a bit of a disconnect, at least recently with the U.S. You've seen a reflattening in the yield curve. I think you've seen a general risk-off sentiment or talk of recession, at least, has crept back into the market. So I think there's a little bit of a divergence right now in thinking. And maybe the scripts have flipped a little bit. Growth concerns in the ECB previously, and I know retail sales data missed the mark today, but with this talk of fiscal expansion, you have them moving in one direction, and now, here it's a bit of a different story, but one where I think right now at least the fixed income market's a bit overbought.
We have seen sentiment, though, consumer sentiment that is really weaken of late, notably with inflation expectations actually rising. And so knowing that consumer spending powers 70% plus of overall GDP growth, what is your expectation from the consumer in that backdrop?
Absolutely. Kristen, that's a great question. And one thing I would highlight for viewers is that consumer spending has been, or consumer sentiment, I should say, has been pretty dour, throughout this expansion, even when, in the fourth quarter, we saw a heady pace of real spending of 4%. What I tend to look at is the consumer balance sheet, which I would argue is still fairly strong. Asset values are relatively high. Liquid asset positions, moreover, are pretty good. Debt burdens are manageable. And moreover, with inflation receding and the job market pretty solid, many workers are seeing real income gains in the vicinity of 2% over the year. So I think the fundamentals are still pretty good for the consumer going forward. I would also add that I think a lot of the weakness that we saw in January was the effects of, bad weather rather than a fundamental pullback, by the consumer. So I think there's still a disconnect between the sentiment numbers and what we're seeing with spending.
So let's talk through, though, the Atlanta Fed indicator, because
Absolutely.
it did recently, just about a week ago, note that it sees negative Q1 GDP growth, so actually an economic contraction. Of course, we know by definition 2 straight quarters of negative GDP growth technically is a recession. Is there anything that is signaling that to you as something to watch for?
So the short answer would be no, and let me back that up a little bit. The Atlanta Fed GDP model, I think it's an elegant model, great work by the Economist there, but it's reliant on real-time inputs rather than taking a broad view of the quarter. So you got some ugly trade data, and I think a lot of that was influenced by repatriation of gold ahead of the tariffs, and that doesn't necessarily translate through to your real-time trade data. So you're not going to see a drag on GDP of 4 percentage points, which is approximately what Atlanta Fed's calling for. Moreover, I would expect a pickup in consumer spending in the back half of the quarter. We only have one month's worth of data there. So I think the consumer spending data will be better than what's factored in, and you're not going to get as much of a drag from trade. So I think Atlanta Fed it's not necessarily off the mark, but it's dealing with the inputs that it has, which is very much an incomplete picture. So I would say proceed with caution when interpreting, the negative GDP print suggested there.
We've got spring break, last 2 weeks of March, early April. We'll see what that can do for overall GDP growth and consumer spending. Larry Werther, he's a chief economist, a U.S. economist at Daiwa Capital Markets. Thank you.
Delighted to be here. Thanks again, Kristen.
Great to have you.